Let's have a discussion on the syllabus. That's the most important thing that you need to understand in order to take a call whether to, whether you're liking the curriculum, whether you want to go ahead with CFA or not. So this is the most important part to understand. Now, the CFA curriculum has been divided into 10 subjects. When I'm saying 10 subjects, please don't get scared that there's so much volume that's going to be there to study. Because say for example, one subject, alternate investment, is just one chapter and that's about 20 to 30 pages. So basically we are dividing the content into 10 subjects over here. So the first subject that we have is ethics. Now, out of the 10 subjects, each of the subjects have been divided into study sessions. And study sessions have been divided into readings and the readings into LOSs. Now, it is just terminology that we are using over here. It's nothing hi-fi. So basically, we've got, say for example, ethics as a subject. Now, this subject has got one study session. One study session is basically a group of chapters, which we call readings over here. Like say suppose we'll have the second subject, that is your Quants. In Quants, we have two study sessions. So in one study session, we'll have about 4 to 5 chapters, and in another study session, we'll have about 4 to 5 chapters. Now what happens is, since it's a global designation, it becomes very important to actually divide the curriculum very, very neatly. Because we cannot have out of syllabus questions or that kind of confusion is not possible to deal with when you are dealing with a global designation. So that is why every single chapter, which we call it as readings, so readings or chapter, is further divided into LOSs. LOSs is basically a subheading of the chapters. So that is your learning outcome statement. So say for example, an LOS is telling you, you need to get an understanding of mean, median and mode. Suppose, statistical terms. So you need to understand mean, median and mode. If the LOS tells you, you need to be able to calculate mean, median and mode, that means sums on mean, median, mode is possible. So the LOS to that level is defining it. You don't have to worry about it because you'll have the entire curriculum with you. You'll have the entire study material with you. So you know exactly everything is given to you what needs to be studied. Basically, I'm just trying to tell you is that the syllabus, the curriculum has been structured in a very, very accurate, in a very, very nice manner, in a very, very organized manner. So say for example, ethics we have one study session, Quants we have 2 study sessions, and when you move along with 10 subjects, a total of 18 study sessions are there, in which approximately in level 1 we will be having around 60 readings, in level 2 approximately 50 readings, and in level 3 the size of the readings is more, it's going to be approximately 35 readings. So we have levels 1, 2 and 3. So let us understand the subjects first and then I'll tell you the differences between levels 1 and 2 and 3. So when you're looking at ethics, that is the first subject with one study session. Ethics has got primarily 2 parts in level 1. One is going to be your 7 standards. First part of ethics is going to be your 7 standards. And the next part of ethics is your GIPS. Now what happens with your 7 standards? Now basically, how many of you have heard of the name Rajat Gupta? Okay, just a few. Okay, quite a few. So what happened was, this person came out of the board meeting of one of his companies, and I think it was Goldman Sachs? No, Goldman Sachs, yeah. So he came out of the meeting, he called up his friend, and he gave the insider information of what was discussed inside the board meeting. His friend made a ton of money by trading on that information. That is unethical. You cannot allow something of that sort. Let me use another example in India. We've all heard about the Satyam scam. So basically the people, the higher top management of the company, along with the auditors, very unfortunate, but along with the auditors, were cooking its books. What do you understand by cooking its books? They were trying to misinterpret information, wrongfully giving figures and all, and they were bleeding the company out of its finances. So they were literally stealing from the company and they were giving wrong figures on the balance sheets and all. We cannot allow that to happen. Every profession, it is very important for every profession to maintain a certain level of ethics. Why does the ethics part become very important for every profession? Say for example, we go to a doctor. It is very important that the doctor is giving us that attention, that time, because our life is at stake. When you're going to a lawyer, it's very important that for the lawyer to be very professional and very ethical, because your life is at stake again, because he's fighting a case for you. When you're going to a teacher, when you're going to a financial advisor as well, because your finances are in his hands. What if he robs you of your entire life savings? You cannot have that kind of a situation in a professional world. Are you understanding? It's very important. It might not, I mean, the doctor and the lawyer example is given so that you understand the importance of ethics, because the institute is going to treat the ethics part very, very seriously. Even when you're registering for the institute's exam on the institute's website, they will ask you quite a few questions, whether you have been convicted for any felony or anything or not. So there'll be quite a few questions which will be on the ethical part of yours. So institute gives a lot of importance to ethics. The weightage, I'll discuss the paper pattern after I'm done with the syllabus part. So ethics is the same 7 standards are covered in levels 1, level 2 and level 3. And the weightage of the subject ethics is also pretty high. It's about 15% in level 1. So the weightage is high. The same 7 standards is being tested in all the 3 levels. So that gives you an indication of how important ethics is to the institute and also to our profession. We cannot have a Satyam scam like that. We cannot have a Sarda scam like that. It's very important for us to be very ethical in our profession. And on a very personal level, I will tell you, if you want to do good in the long term, you have to be very, very ethical. Otherwise, you will not do good in the long term. I'm not talking about the short term. In the long term, if you want to do good, whether it is a job or a business or a profession, no matter what be it, you have to be very, very ethical. So the 7 standards will also have sub-standards. Say, for example, one of the standards is integrity of capital market. In that, there is a standard called market manipulation. So you cannot spread rumors. I cannot, just because I'm a big investor, I cannot just tweet that according to me this stock is going to be falling. And you know, just or the stock is going to rise. And when everybody purchases the stock rises, I will sell my own shares. Because I did not want to make a loss. And the share is very bad. That company is very bad, terrible. You cannot spread those rumors. So that becomes a violation of that particular standard. So 7 standards are there. And within those also you have sub-standards. So these 7 standards are going to be the same in all the 3 levels, and you'll have to be very comfortable with that. Ethics seems to be a little more subjective kind of a subject, because the kind of questions you get on ethics is going to be like, say suppose this person so and so is a CFA, he did so and so, this happened in his organization, he was working with this client gave him money for this, he did that, he did this. So there'll be a little story kind of a thing in 7-8 lines. And you need to answer which standard has been violated, or whether a standard has been violated or not violated. So that is why the understanding part becomes important. Ethics seems to be a little difficult from most of the students' point of view, because it is a little more subjective. Because you know, you cannot do a 2 plus 2 and get the answer. So ethics, a lot of practice is required. The classes will not take very long, because it's just 7 standards that we need to do. It still takes a while. It's not going to be that short as well. But the practice part is going to be more important. So ethics, the only way to crack ethics subject is going to be with practice. How you are supposed to be studying, how you are supposed to be practicing, all those things once I start with the classes, I'll discuss that also separately. Then you have something called GIPS. Now, when you're looking at, say for example, annual reports, when you pick up a Reliance's annual report or a Tata Motors or a HUL or anything, when you're looking at these annual reports, you would see that all these annual reports have been made using the same set of standards, same set of accounting standards. Why do we do that? The CA Institute will provide the accounting standards, or the US GAAP in the US is going to give you those accounting standards. The standards are important, 1, because the comparability increases. 2, because we don't want the companies to make accounts the way they feel like and try to show the information that they want to, like Satyam. We want them to make the statements in a same manner, following certain set of rules and regulations. That becomes very important. Similarly, these mutual funds also, or fund houses also, should have a set of rules and regulations. Now today, Anand Rathi comes and tells you that we are earning 25% return per annum. Motilal Oswal comes and tells you we earn 40% return per annum. That is absurd. Now there is no rules and regulations as to how to calculate the return that you're earning, correct? One may be following, Anand Rathi has taken, let's say, I'm just taking examples with these names, they're not the correct figures. So let's say they are saying that we have taken average of last 5 years. And Motilal Oswal is saying I have taken average of last 2 years because uske pehle, 3 years before, my earnings were very bad. So you cannot do this kind of manipulation with your figures over here. Right? So there should be certain rules and regulations based on which, some standards based on which you will show your investment performance. So GIPS stands for Global Investment Performance Standards. So how do you show your investment performance? It is standards based on that. GIPS over here is going to be just a few pages worth of content. It is just an introduction. In level 3, we will have a full-fledged study session. It's going to be, people find it a little annoying honestly. It'll be around a 60-70 page content once we move to level 3. So GIBS is going to be one full-fledged study session when you move to level 3. In level 1, ethics has got 2 parts, 7 standards in GIBS. Now when I'm talking about levels 1, 2 and 3, level 1 has 7 standard in GIBS, level 2 will have 7 standard plus a small chapter on research analysts, because you could also be looking at a profile where you would be a research analyst, where you're going to be doing equity valuations and all of that. And in level 3, we have the same 7 standards plus asset manager code, because there are a lot of mutual funds, there are a lot of asset managers, because you will be managing a lot of people's money, a lot of people's funds and all. So there would be specific standards for that. So ethics is mainly 7 standards, that's like your 80% of the syllabus, and 20% is GIBS in level 1, research analyst in level 2, asset manager code in level 3. But primarily it is 7 standards, correct? The second subject is going to be your quants. Now in the quants subject, one question that I'm given quite often is that I'm not good at maths, I don't like maths, I don't like statistics, I did not have maths in class 11 and 12, I don't have maths in college. So that is one of the questions that I'm given quite often. So first of all, you don't need to have maths as such in 11 and 12 or the, of course, before that I'm expecting that until class 10, of course, you would be having mathematics as a subject. But in 11 and 12, there's no mandatory need that you need to have maths. Quants is going to be there in level 1 and 2 only. You do not have quants in level 3. Now when you're looking at mathematics, we don't have calculus over here. So trigonometry, calculus, algebra, geometry and all these things are not there. When you're looking at maths, let me just tell you, if you're looking at the subjects of this part, we are going to be focusing one on probability, one on statistics and annuity. So these are primarily the 3 components of mathematics. So if you're looking at 11 and 12, if you have done probability really well, then I think you'll find this easier. For those people whose maths is good, for the ones with engineering background or economics honors or maths honors background, you will find this subject more easy, because you people have a better knack for this. But even those who are in commerce, who are good in in class 11 and 12, or in graduation, they will be liking this subject equally. So there should not be any problem. For those who did not have maths in 11 and 12, we are going to be covering everything from scratch anyways. So you would not have any issue that way. Of course, you'll have to put a little extra effort compared to the others. Similarly, I'll come down to another subject, FRA, a little later. When you're looking at FRA, that is financial reporting analysis. So the commerce guys are going to be having an edge in that subject because they understand accountancy well. The engineering ones will have to put in a little extra effort. Economics honors will have an edge with the economics subject. We have economics as well over here. Now, when you're looking at finance, finance is not technically like we treat finance as a separate stream. So it's not like I'm doing commerce so I can do finance, I'm doing engineering so I cannot do finance. Because again, let me tell you, for most of the people, a majority of the people in the B schools are going to be from engineering backgrounds. And they end up taking finance in the second year and end up getting into investment banking and all of these profiles. So you cannot say exactly that finance is a non-commerce subject or a commerce subject. Finance is finance on its own, and it has got its own subjects. So you understand the depth of knowledge that you're going to get in the world of finance over here. So different people will have different edge in different subjects. We will have to see what suits for whom. When you're looking at quants again, now say for example logarithm will be needed, or let's say an index number will be needed. When we were studying in school in index numbers, we had done very complicated questions. But over here when I'm doing quants, all I need is that a to the power m into n whole to the power n is equal to a to the power mn, or a to the power m divided by a to the power n is equal to a to the power m minus n. That is all that of index numbers that you will need, nothing else. So it's not like we are going to be doing index numbers. It's just that you've studied, you've done plus and minus. It's not that we are going to do subtraction or addition or something. It's just that you're going to be using it. When you're looking at logarithm, say suppose log a, say a to the power x is equal to y. So log y base a is equal to x. That's all you will need. You don't need anything other than this for logarithm. So it is not like you are going to be doing a chapter on logarithm or you're studying maths as such. You're going to be looking at the application of the same. So for those who think they're very scared of maths or something, trust me, I'll take care of it because we are going to start everything from scratch. Of course, I'm assuming that this much application you can do. Nothing more than this is required from your end. Even with respect to probability, now if you ask me the formula of Bayes theorem, I don't know how many of you did not have maths in 11 and 12? A few. So Bayes theorem you might not have done, I believe. So now for the rest of you, those who've done Bayes theorem, I don't know the formula of Bayes theorem. I will not be able to write the formula of Bayes theorem for you. Yeah, but I can derive it for you in 2-3 minutes. We will do the sums of Bayes theorem in the class, but you will not use the formula only. You will just draw a simple tree. I'll do that once I start with probability and all. And you'll be able to do all the sums of probability without knowing a single formula. Right? So even those who did not have probability or maths in 11 and 12, please don't worry about it, because we'll start from scratch and most of the formulas I also don't know. But I know how to prove those formulas for you. So even when you're looking at quants part, we need to start liking the subject instead of getting irritated or getting scared of the subject. When you're looking at when you're looking at statistics part of it, some of you might have done in 11 and 12 mean, median, mode, standard deviation. So when you've done standard deviation, say for example, I'm sure you would not have done the derivation or the logic behind the formula. Why standard deviation is called standard deviation? We will go to that level of depth. So we are going to start from scratch with respect to statistics, because see, when you're looking at finance, when you're looking at projections, if I want to make any forecast for the future, for making a forecast for the future, don't you think probability is going to be a very important thing? What does probability mean? There is a 40% probability this will happen. There is a 30% chance this will happen. There is a 40% chance this will happen. So ultimately, when you're looking at probability, it is going to be used in forecasting. What are the chances of this happening or that happening? If this particular political party wins, the market goes up. If this particular political party comes with a coalition, then the market goes down. Are you understanding? So you need to start understanding this. So we are going to be using probability. We're going to be using statistics. What is the average return? Average is mean, right? So we are going to be applying all these things. When I'm talking about mean and median also. Now suppose, let me give you one more example and then I'll move a little faster. Say suppose there are 10 years return. The stock is earning 10%, 11%, 12%, 8%, 9%. So the stock, most of the returns are in the range of 8 and 12. In one of the years, the stock earned a 40% return. Let's say I've got these figures. The average of this is going to be, let's say there are more 8, 9, 11, 9, 8, 10. So I've got about 10 returns over here. I'm just giving you a rough example. The average of these returns is going to be somewhere around 18% or so. Or let's say I'll make it 80. Because of this 180 figure, average is going to be summation of this divided by 10. 80 by 10 itself is 8. So the average of the rest of the figures is close to 10. And because of this 80%, one absurd return, I'm getting an average of 18%. But don't you think that 80 is one weird return and the average is somewhere close to 10? When you're going to be looking at median, what is median? For those who have not done statistics, don't worry about it. I'm just trying to give you an introduction as to what kind of work we'll do. When you're looking at median, median is going to tell you out of 10 values, which is the 5th largest value, basically the beach ka value, the middle portion ka value, the middle place's value, the value that is coming in the center. That is going to be somewhere around 10 or 11 or something. So mean is going to be affected by the by huge values or huge negative values, but median is not affected so much. So are you understanding? We have to now understand what is median. So have you done this in school level? Probably no. That what is the difference? What do you understand from mean and median? Where would they be different? So there is a lot of analysis that we'll be doing. So quants is going to be a lot of statistics and probability. Annuity, most of you would not have done in class 11 and 12. A very few would have done, I believe. ISC board does annuity in section C. At least that was at my time. So when you're looking at the annuity portion, that is about your time money calculations. If I'm talking about 100 rupees today, it is not the same as 100 rupees after 1 year. Because if you give me 100 today, I can deposit it in the bank, and the bank is going to give me 107, 108, depending on the rate of interest in the market. Let's say 108. But if you give me 100 rupees after 1 year, it is not the same as 100 rupees today. So all the calculations with respect to money needs to be done, and that is what we'll do in the annuity part. So when you're looking at quants, it's probability, statistics, and annuity. And when we move to level 2, it gets a little difficult, and the major part of level 2 quants is very small. In level 1, we will have quants with 2 study sessions with about 8 to 10 chapters or so. In level 2, we have only 3 or 4 readings. When you're looking at level 2, the primary job of quants is going to be forming an equation of this sort. Say for example, I want to make a forecast about SBI stocks prices. SBI is India's largest PSU bank. So what is going to be the SBI return? Let's say SBI's return is equal to 5 plus 3.2 into interest rate plus 1.5 into inflation rate. So how does SBI stocks return is dependent on interest rate, inflation rate, unemployment, GDP growth. So we'll try to figure out some relationships. We'll try to figure out some kind of equations and all so that we can make forecasts and all. So that is what we are going to be studying in the Quants part. Quants is not there in level 3. It is there in levels 1 and level 2 only. In level 1 Quants, we are talking about probability, statistics and annuity. In level 2, we are going ahead with statistics. We are going to be focusing on the relationship, the equation. This is what we are going to be focusing on in level 2. So that part is Quants. So for those who have or don't have maths, that is not honestly a determining or deciding factor whether you are supposed to be going ahead with CFA or not. The deciding factor to go ahead with this curriculum is whether you like the syllabus, whether you want to get into finance or not get into finance. So that is the reason why I'm trying to explain the syllabus in so much detail so that you take an informed decision. Because whenever anybody comes up to me to ask whether to do or not to do, I'm like, you get the information and you decide, because I cannot decide what you like or what you don't like, right? So it's up to you to decide what you like or not. And instead of not understanding and getting the information and deciding for your next 2 years, 3 years and then your career, it's better to have all the information and then take a call. So that is going to be your Quants bit. Then the next subject that we have is economics. Now when you're looking at economics, it's got I think 2 or 3 study sessions. They just clubbed one this year, I guess. So when you're looking at economics, there will be about 8 to 10 readings or so. It's basically divided into 3 portions. Microeconomics, macroeconomics and international economics. When you're looking at microeconomics, it's basically your demand and supply, cost structure, firm and all of that. So most of you would have done class economics in class 11 and 12 as well. So you would find quite a few things overlapping over here. Equanus people would find a lot of overlap over here again. But let me remind you, the questions in economics are very tricky. So the practice is going to be a very important part when you're looking at the economics part of it. Right? So the practice part will be quite important, because I've seen quite a few students neglecting economics in the beginning because they think they know everything over here. But you'll have to understand the kind of depth of understanding that is required. You'll have to do the classes and you'll have to do a lot of practice over here. The questions are difficult in this subject. Right? So when you're looking at microeconomics, we're talking about demand and supply, average total cost, fixed costs, and the long run shutdown point and all of that. When we get into macroeconomics, then we are talking about, monopoly, oligopoly, monopolistic competition and all. So these things become very important for us to study. Now, why does economics become so important? Why is the monopoly, monopolistic competition important? Now, say suppose there is a company which is running a monopoly. They will be able to charge whatever prices they want. So for those companies, do you think their valuation will be high or low? Their valuation should be higher because their margins are good. Say for example, for a tobacco company, the elasticity, if for those who are not understanding the terms because you've not done economics, don't worry about it. Just try to get the gist of it. For tobacco company, the elasticity of the consumer is very low. We'll study elasticity in microeconomics. Again, everything will be from scratch. So for the engineering students who did not have economics, please don't worry about it. You had your advantage here. So just wait. So in economics, when you're talking about a tobacco company, say for example, no matter what prices you increase in the cost of cigarettes, the consumer is still having it because he's addicted. Now what happens is, so if the government is increasing taxes, will the company bear the taxes or the consumer? The consumer, because the company will increase the prices, because the company knows that even if I increase the prices on cigarettes, the consumer will happily pay. Or not happily but pay. So therefore, should the valuation go down or not? Probably no. But say suppose if the government is going to increase taxes on cars, automobiles, in that case maybe people will be buying less of cars because it is not a necessity. Maybe they'll try to stretch, instead of 7 years, they'll try to use the car for 4 years, they will try to use it for 5 years. So how is it going to impact? So if a tax comes in, so whether the consumer is dependent or not dependent. So all these factors we have to see. Whether there is a lot of competition. Now Jio comes in. Now all these people are complaining that the competition is, they are competing on unfair grounds and all. So there is a competition act in our country. So we need to understand those things. So whether you are trying to build a monopoly, there are laws for that. We are not studying the law part over here, but we need to study the application. So monopolistic competition all is very important. Otherwise, how do you do the valuation for Bharti Airtel or a Vodafone Idea merger or a Jio? So how do you do the valuation? So economic becomes very important. The macroeconomics part, we are going to be talking about unemployment, GDP, monetary policy, fiscal policy. Monetary policy is what the RBI does. If the interest rates are increasing or decreasing, of course all the finance professionals are going to be bothered about it. So if the government is doing the fiscal policy, so government either will increase expenditure, so how is it affecting the goods prices, unemployment, or the government is going to be raising or reducing taxes. So how is that going to be impacting the economy? Because if there is not enough demand in the economy, if your GDP is not high, that is your output, your growth in the economy is not high, should you produce more or should you produce less? You should produce less if the growth is not there. So how do you value the company? So everything is ultimately going to get related to economics, because we are a part of the economy, and no matter what profession you are in, the economy is going to affect you. So it's very important to understand the application of economics part over here. So that is what we study in the macroeconomic section. Then when you're looking at international economics, the first one is a very easy reading, that is on your international trade, why international trade should be there. It's a fairly easy point, and with a few theories, Ricardo's theory and all, a couple of theories we are going to be studying. It's fairly simple, it's fairly short. We are going to understand why international trade should be there. The second reading is very important, where we discuss on the currency. Now even the smallest shopkeeper in, let's say, Bada Bazaar in Calcutta would be bothered about the dollar rates because his products are being imported from China. So ultimately the dollar rupee exchange rate is going to be impacting that person, and he would be having an idea. No matter what scale of business you are running, you would be seeing our parents, everybody at home reading the newspaper in the morning and so involved about what's happening in the political part and the economy. They're all very bothered about this, because ultimately it does impact our lives. So when we start out with the classes, I'll actually be nagging you people very badly to start reading newspapers, to start following the markets, and to start reading books. That is going to be one of the most important things you'll have to start doing. I'll discuss on that once I discuss your job prospects and all, that why it is going to be so important to actually start reading. Reading is going to be the most important thing that you have to do. You have to start. So currency is going to be one important part of international economics. When we look at level 2, we have only 3 readings in level 2. It's a very small chunk. Economics is very much a small part in level 2. We're going to be talking about currency. That is going to be 80% of your economics. So one huge chapter on currency, foreign exchange. Foreign exchange is very important. Of course, you understand with the kind of globalization that is happening right now. And the other 2 readings are very simple, small readings about GDP growth rate, how to calculate growth rate. Because if you don't know how to calculate growth rate, how do you do the valuation of companies? Based on which company is growing in what manner, or which industry is growing in at what level, we will be able to do the valuation for that company. So that is what, so growth rate, currency, and one theory chapter is what we do in level 2. Level 3 as such we do not have economics, but there is one extensive reading as to how do you form expectations about the economy, because as a portfolio manager, you will need to be able to assess what the economy, where the economy is headed in order to take financial decisions. So in level 3, the application part is going to be there, not technical economics, but how do you understand the economy and evaluate whether to invest in shares or to invest in fixed income or to invest in real estate. So that's going to be a little far off. I'll not be able to explain so much. So that is going to be in your economics part of it. Then in the next part, we move to your financial reporting analysis. Now financial reporting analysis has got 4 study sessions with about 3 chapters, 4 or 5 chapters, I think 4 chapters and 2 or 3 chapters in each of these. Now this is going to be a full book. So your entire curriculum, 10 subjects, have been divided into 5 books, right? So the books are not that fat also, so it's okay. So you've got 5 books. Anyways, we'll come to that. So when you're looking at financial reporting analysis, now the commerce people will have a little edge. Of course, the engineering people will have to work a little harder over here. So everybody has their own advantages over here. When you're looking at financial reporting analysis, you do not have to make accounts. It is not about preparing accounts. It is not about making financial reports. It is about reading, understanding and analyzing financial reports. It is financial reporting analysis. There is no journal entry. There is no preparation of accounts. There is no preparation of balance sheet or PL account. Nothing. What is there is, if I give you a financial report, If you are if you're an analyst, if you're an investment banker, if I give you a financial report, you need to be able to read, go through it, understand what the company is doing, what it's up to, whether there are any manipulations. How do you do the valuation of a company without studying the company's position right now? So you have to be able to understand, analyze, and go through the financial reports at length. So the understanding part and analysis part of FRA is needed. FRA is also going to be there in levels 1 and 2. It's not there in level 3. So when you're looking at financial reporting analysis, the first study session is fairly theoretical, very small, easy chapters. It's talking about what is US GAAP, what is IFRS. In India, we have the CA Institute that gives us our accounting standards. In the US, you have your FASB that gives you your US GAAP. So our accounting standards are accounting standard AS 1 to 32 and all. And the accounting standard that the US follows is US GAAP. Now, because of globalization, because everybody is investing in each other's countries and all, therefore, we need kind of a global kind of standard, which is known as IFRS. So India is also, the institute is also coming up with new standards, which is more like IFRS, and that is known as Ind AS. So we will be studying, of course, it's a global designation as I told you. You will not be studying any country's law or taxation or standards. We will be studying IFRS in general and a little bit of US GAAP also. We will be studying the comparison between IFRS and US GAAP and how the accounts and all are prepared. So the first study session will talk about what is journal, what is ledger, what is accounts, the basic terms and all, what is US GAAP, what is IFRS, understandability, the principles of how you make financial reports and all. So that is what is there in your first study session. Very simple. For the engineering people, you'll have to do a little bit of extra. Now, some people have questioned, do I need to do additional reading before the classes? Not needed. So everything in total will be covered over here. So you don't have to do any pre-read material. I've been given this question earlier. You don't have any pre-read material or something. Everything from scratch, we'll take care of it. In the next study session, we have a chapter on profit and loss account, your income statement, what have you earned throughout the year, your balance sheet, which gives us what you own and what you owe, the assets and liabilities, the cash flow statement, and your ratio analysis. So the name of the chapter is Financial Analysis Techniques. It is your ratio analysis. Now when you're looking at ratios, for the commerce people, you've done ratios in class 11 and 12. When I tell you debt equity ratio, whether it should be higher or lower, you will immediately tell me it should be lower, but ideally it's not the case. It should be optimal, because I'll discuss, once I do ratio analysis, I'll discuss on that. So don't expect in the exam that they will give you a question, calculate this ratio. No, the questions will be in the manner that if I follow IFRS instead of US GAAP, this particular ratio will be higher or lower. So the application is going to be there. You have to analyze, you have to understand. You will not be able to mug up and do this. I'll come to how you're supposed to go ahead with the preparation part. Mugging up is not allowed. If you're looking at mugging up, please don't do this course. It will not help you. So mugging up will not work. I'm telling you very, very bluntly on that actually. Mugging up is not going to work. So it is financial reporting analysis. So we'll have each of one of these readings on how to make up income statement, what have you earned, your current situation, what are the assets that you have, balance sheet, cash flow statement, and ratios. In the fourth study session, it's a little difficult or tedious actually. We will have how do you treat inventory, how do you treat taxation in your accounts. Again, when you're talking about taxation, we are not going to be talking about your tax rules or how to make the statement, how to prepare taxes. But what happens is, say for example, the government has allowed you that you don't need to pay taxes for 5 years because you are doing a business in backward region. The government does all these things in order to promote growth and all that. Okay, 5 years you don't have to pay taxes. So that is based on the tax law. But you make the accounts based on accounting standards. So the treatment of tax becomes different in two different places. Taxation is telling you don't have to pay taxes, but accounting standards is the basis for making accounts. So how do you analyze that part? Say for example, I'll give you another very good one. There is a company which is doing business in multiple countries, and the growth rate of that company, the sales is growing in a country in which the tax rate is low. And there is another company which is doing again business in multiple countries, and its sales is growing in that country whose tax rate is high. don't you think with time the average tax rate of the first company will go down because more sales is happening in a country where there is lower tax rate, and the average tax rate of the company of the second one will go up because its growth of sales is happening more in that country in which the tax rate is high, because in whichever country you have more sales, you'll have to pay taxes accordingly. So there are multiple tax jurisdictions that you're operating in. So we will not study any of the country's tax laws. We will understand how the tax is going to impact your balance sheet PL. So understanding the impact of taxes on the balance sheet PL, on the financial statements, is what we will do over here. And then there is a chapter of assets and liabilities. In assets, we'll be talking more about depreciation. We'll talk about how do you treat goodwill on your balance sheet, intangible assets on your balance sheet. So we will talk about 3-4 particular assets. How do you do the accounting for that? Again, not making accounts, just analyzing accounts, because you need to understand them in order to interpret them and use it for valuations and all. Liabilities, how do you show bonds on the balance sheet? How do you show leases on the balance sheet? Now say for example, a company has got two options. Either it can rent out a, let's say it's a real estate company. It has to rent out a crane, suppose. So now this to lift boulders and all of that. Now there are two options. Either you take a loan of, let's say 2 crore rupees. You take a loan of the loan to buy the crane, and you keep on paying EMI for that. The EMI is approximately 10 lakh rupees per annum. Suppose, let's just assume. The other alternative is that I will take the crane on rent and I'm going to pay 10 lakh rupees as a rental. In the first situation, you've taken a loan and bought the crane. In the second situation, the crane is not yours. But don't you think both the situations, it is very similar, because you ultimately pay 10 lakh rupees and you're using a crane. Now one company takes a loan and buys the crane. Another company does not take the loan and buy the crane, but at least their operations are similar because they're both ultimately using the crane and paying 10 lakh rupees per annum. So how do you compare the two financial statements? I'm not being able to explain very clearly over here because that's going to be covered in this liability section. So once I do the chapter, I'll tell you how exactly the treatment is going to be done. So liabilities is going to be quite an interesting chapter. This subject is interesting. This becomes a little irritating, but it's going to take hardly any time. And the last two chapters is basically very, very simple. It is more like a summary of these. This is the major crux of your FRA. It is going to be just a summary as to, how managers can manipulate over here, how you as an analyst can detect those manipulations. And when we are going to be doing this chapter, I'll simultaneously be talking about how manipulations can be done over here, and how as an analyst you will be able to detect those manipulations. So this will be taking hardly any time for us. It's more of a summary of this. Is everybody comfortable till here? So that is your FRA, Financial Reporting Analysis. In the next book, so this is one book, this is book 2. In the book 3, we have the subjects 5, 6 and 7. So the first we have is corporate finance. Now when you're looking at corporate finance, I want to actually distinguish between the two, corporate finance and equity. When I'm looking at corporate finance, say for example, when I'm in a company, suppose I'm working in Hindustan Unilever. It is a manufacturing company. They're manufacturing soaps, Detolls and whatever, right? FMCG products. So I'm into a manufacturing company, but don't you think that company will also have its own finance department? How will they decide as to whether to take a loan or whether to issue equity shares in the market when I want money? How will they raise capital? Whether I should give dividend or I should not give dividend? How much dividend should I give? Who will decide the details with respect to dividend? Who will do the working capital management? Today the company will have a lot of money blocked in inventory. They will have a lot of wages to be paid. They will have a lot of debtors from whom the money is receivable. They will have a lot of short-term loans. They will have a lot of cash. So how do you do the management of that? Working capital management. The short-term resources that you have, how do you manage that? How much of debt equity ratio to have? So say for example, if I have my balance sheet, if I have 100 worth of asset, should I have debt of 40 and equity of 60? Should I take a loan of 60 and equity of 40? Or should I take it an 80-20? How do you decide the ratio? We will discuss that in leverage. Corporate governance. Now what happens is, the company is being managed by the CEO, CFO and all. But actually the company is owned by the shareholders. I have shares of HUL. So I am the owner of the company, a small tiny part of the owner of the company. But then the management of the company is with CEO, CFO. Now these people want to take fat salaries home. But I want these people to earn maximum money for me because I will get returns. So how is a corporate governed? Because there is a conflict over here. So we need to have a board of directors in between who on the behalf of shareholders will oversee the CEO, CFO, the entire management of the company. So corporate governance, that is what we need to study, and it has become very important in today's time period. So corporate governance is something that we'll have to focus on. So working capital, corporate governance, how do you raise money, which projects to invest in. I have got 5 different alternatives. I can open a factory here, I can open a factory there, I can start this product, I can start that product. There are 5 alternatives and I have 1 crore rupees or $1 million. So I have $1 million, where do I invest? Which project is better? How do I mix it? Capital budgeting. When I'm raising money from equity shareholders, preference shares and debt holders, if I'm raising money, don't you think I need to pay this guy dividend and returns? I need to pay this guy dividends. I need to pay the debt holders. I need to pay him interest. So if I'm raising 100 rupees from these people, $100 from these people, this guy is charging me, let's say 10, this guy is charging me 12, this guy is charging me 15. On an average, these people want 14. So if I'm raising $100 from these people, on an average, I need to pay $14 to these guys. This becomes the cost of raising capital. And obviously, I'll have to make sure that I'm investing this 100 worth of asset in such kind of projects so that my return is at least 14%. Otherwise, they'll take their money and my company will be shut. So first I need to raise the capital. Where do I raise the capital from? And then once I raise it, I need to evaluate what I need to pay them. And accordingly, I need to decide where to invest. So HUL has multiple factories. It has got multiple products. Which product to launch, which product to place money in. Are you understanding that? So that capital budgeting and cost of capital comes in. That is a part of corporate finance. Cost of raising the money and how do you allocate? How do you budget that capital that you have raised? So I'm raising capital, I need to budget that capital. So there are multiple ways in which we can decide as to which project to invest in. So that becomes your corporate finance. So corporate finance is when you are sitting inside the company's finance department, then how do you take financial decisions? So the understanding of corporate finance becomes important. There is another subject I'll discuss afterwards, equity. When you're looking at equity or equity valuation, you are not a part of the company. You are sitting outside the company and you are saying this company shares is good, you buy this company shares is expensive, you sell this company shares is cheap, you buy this. But when you're talking about corporate finance, you're working in the finance department, you are talking about the finance within the company. And the company need not be a financial institution, a bank or a investment bank or something, or a fund or something like that. Because this is the finance department of any company. So CFA is about finance. The next subject we talk about is portfolio. So when you're looking at portfolio, say suppose we've probably heard people at our places, our seniors or elders talking that you should not put all your eggs in one basket. Or they talk about, at times you might have heard them, that don't put all your money in the same company. Buy 2-3 different companies or 5-7 different companies. Or don't put all your money in the steel industry. Put something in steel industry, something in FMCG, something in pharma. So try to put your money in multiple places. What is the logic behind that? Because if I put entire money in steel market and if the steel market goes down, I lose my entire investment. But what if I have put my money in 4-5 different industries? Then one industry is doing good, one industry is doing poorly, but on an average I'm getting balanced out. Now do you understand covariance comes in over here? Covariance tells you how two variables move with respect to each other. For those who've done covariance in 11 and 12 maths, we're not going to be doing maths, we're going to be doing the application. So don't treat it as maths as such, it's quants, it's statistics, it's primarily statistics. So I need to understand whether if one variable moves up, the other one also moves up, and if one goes down, the other one is also going down, or are they moving in opposite direction? If they're moving in opposite direction, it is very advantageous for me, because if one side there is a gain, the other one is loss, they're giving me an average return. If one of the stocks is losing out, another stock is giving me a good return, and that is balancing out each other, right? So understanding, when you put multiple investments together, understanding that part is a part of your portfolio. So portfolio is a summation of all the assets, all the investments that you're holding together. So portfolio is going to be grouping all investments together, and in totality, How do you calculate their risk, their return, how to structure the portfolio, what are the risks involved in the portfolio. Like say for example, if you're talking about a portfolio for someone who's at the age of 25, it's going to be very different as compared to someone who's at the age of 50. Because someone who's 25 can take a lot of risk because right now he has his or her whole working life ahead of him. But when you're talking about someone who's at the age of 50, their portfolio management has to be done in a separate manner because they will not be able to take a lot of risk. They need liquidity because they will be retiring very soon and they need to start withdrawing living expenses. But someone who's 25 does not need to withdraw money for the next 15-20 years. So how do you do the portfolio management for individuals? And portfolio is not only needed for us individuals. Banks also have their own portfolio. Insurance companies' portfolios could be there. So there are a lot of entities also who need to get their portfolios managed. So that part comes in your portfolio. Then the next subject we talk about is equity. So equity, first of all, we have two readings which is actually very theoretical. It's talking about what is equity share, what is preference shares, what is equity all about, what are the different instruments available in the markets. So it's going to be very basic. Then the interesting part is, you must have seen Sensex and Nifty on CNBC at times, CNBC, NDTV Profit, whatever you're following. So you see how the markets are going. What is Nifty? Nifty is basically the summation of 50 stocks in the market together, 50 largest 50 companies in India, so that it tells us, and from different industries, so it gives us a kind of an overview as to how the Indian economy at large is moving. Because we've taken from different sectors, you've taken the largest 50 companies, so how the 50 companies are moving, whether they're increasing in totality or decreasing, that will give you an idea as to how the Indian markets are moving. How do you do the calculation of that? What are the different methods of calculating indices? Like the way we have Nifty in India, we have S&P 500 in the US. So how do you do the calculations for the same comes in your equity section. Then how do you do the valuation of different companies? Say for example, one company gives you dividend on a regular basis. There is another company which is very new. It does not give dividend. It keeps on reinvesting and it is a very high growth company. How do you do valuation for that company? Say suppose there is a company which has got negative cash flows. How do you do valuation of a company like that? Say suppose I want to do the valuation of, let's say, Patanjali. I can try to do the valuation of HUL, Godrej, Imami, which are in similar FMCG businesses, and based on how their valuation is done, I can have a comparative analysis between Patanjali, which is another FMCG company, with all these 3-4 companies and try to come up with a valuation. So there are multiple ways in which equity valuation can be done. We'll study that in equity. So you are trying to understand what should be the share price of the company, and that could be for multiple reasons. Maybe you want to acquire a company. Suppose Flipkart wanted to acquire Myntra Jabang. Walmart wants to acquire Flipkart. So at what prices? Walmart has acquired Flipkart. So at what prices? What should be the valuation? So we need to check in the equity part, how to do the valuation. And there are a lot of theories with respect to the market and all those things we are going to be studying over here. The industry and all becomes important. Now suppose if the industry is doing very, very well, let's say for example, like the tobacco example I gave you, or let me take another one, say suppose, let's talk about the telecom industry. So don't you think if I want to do the valuation for Reliance Jio, I need to understand the telecom industry at large. Okay, this is the population of India. I'm assuming 80% people are using cell phones. So that is the amount of cell phones. On an average, 200 rupees is a bill for every Indian. So let me just take a very, very rough ballpark figure. So let's say out of 125 crore people, 70% people are using phones, and 70% let's say are using phones. So that's going to be how much? 87.5 crores, and they are going to be giving me a 200 rupees roughly rental on a per month basis. So 87.5 crore into 200, that is the revenue of all the telecom companies taken together. What is my market share out of that? So studying the balance sheets of Airtel and Jio and Vodafone and all, can you not understand what is the number of subscribers? An average bill of this amount. You will get it from the balance sheets and all. So don't you think the industry's analysis is required? Don't you think before Jio came into the market, they must have done this kind of an analysis? So when you're doing the valuation of a company, you need to do that level of analysis also. When you do the valuation of a company, you need to do the industry analysis also. That is also going to be there in equity. So this is what we study in equity. Next, when you're looking at this completes your book 4. Then you have fixed income. Fixed income is kind of voted the most difficult subject of the entire CFA curriculum. Although again, I can just assure that as long as you understand the curriculum, you will not find it difficult. It's just that the understanding at a very, very good level is required. When you're looking at fixed income, we can invest in shares. We can also invest in bonds, debentures that you might have studied in 11 and 12, fixed deposits. So fixed income securities means those income securities, those securities which are going to give you a fixed income regularly. Because when you're investing in shares, there is no guarantee what income you're going to be generating. But in case of fixed income securities, you know that this is going to be the fixed income that will be generated on a regular basis. So that becomes your fixed income securities. And how do you do the calculations, valuations, analysis and all? Now say suppose if interest rate is increasing, if interest rate increases, the bond value falls or rises, bond value is going to be falling. Now understand, I know people are getting confused. Understand, when the interest rates in the market increases, you will not be happy about it. Because I have already invested at lower rates and my income is fixed. I did an FD, fixed deposit in the bank, when the rate was 7% for 10 years. Now the FD rate has become 8%, but I am stuck with the same 7% for the next 10 years. So those kind of calculations, interest rate becomes very important, and interest rate is going to depend on macroeconomics. So your fixed income security is going to totally depend on interest rate, and interest rate can be calculated using economics. So fixed income securities is going to be a lot of fixed income valuations and all, and only when I start the subject I'll be able to get into a lot of details over here, but it's very interesting. It is not as difficult as people perceive, and especially once you're done with the class, you'll not find it that difficult, provided you have understood. So you have to understand, you have to focus on understanding the part. 9 is going to be your derivatives. It's a very small subject that has been given in level 1. Level 2 and level 3 has a little more extensive content on this. Now suppose you're scared that there will be a fire and therefore I'll have a lot of losses at my factory. You take a fire insurance, you're scared that I'll fall ill and the hospital bill is going to run very high, so therefore you take a mediclaim. But if I'm scared, say for example, that rupee-dollar rates will change, I'm an importer. I'm paying 64 rupees and I'm buying $1 worth of goods and services from outside. But what if the dollar rate becomes 68 rupees per dollar? For the same $1 worth of product, I'll have to pay 68 rupees. I'm scared. There is no insurance company to do that. I am a tire manufacturer, CIIB tires. The rubber prices are X per kg or per ton. I'm not sure about the metrics they use. But what if the rubber prices increases? I can't just go tomorrow and increase the tires prices in the market. So what if the raw material price increases? There are these issues are going to be there. So how do you manage risk? Managing risk is done through derivatives. So derivatives is one of the most interesting topics of finance. I'll just be able to say this much right now because just to introduce this topic I need a couple of hours. So I'll not be able to get into the derivatives part, but when you're looking at risk management and all, with respect to finance, interest rates, suppose I'm scared that the interest rate will rise. I want to take a loan, but I don't want to take a loan today. I want to take a loan after 6 months. But I'm scared that the interest rate will rise after 6 months. I will use derivatives in order to lock my rate today. So we use derivatives for all of those risk management related transactions. Very small content in level 1, level 2, level 3 has it a little more extensive. And the last subject is going to be your alternate investments. So now when you're looking at investments, either you can invest in equity shares, shares of the companies, or you can invest in fixed income securities, bonds, FDs, fixed deposits and all. Anything, all the other alternatives are classified under alternate investments. So alternate investments could be commodity, you can hold gold. Alternate investments could mean real estate. Alternate investments could be paintings as well. A lot of paintings are valued. Right now the traction for paintings is increasing in India now, but in the West they're very valued. So paintings could be there. We don't do valuation of paintings, don't worry. But real estate, commodities, private equity, a Flipkart investment. If you want to buy shares of Flipkart, will you be able to buy it? No, because it is not available in the stock market. It is not a public security. It's not publicly listed. It is a private company. So private equity investments, venture capital, when people are investing into new kind of businesses, startups and all. So that is going to be there in alternate investments. Hedge funds and all we'll discuss later. That is a part of alternate investments. So alternate investment is just one chapter, very small, one chapter, 20-30 pages or so. When you're looking at level 1 and level 2, the exactly same 10 subjects are going to be there. It is very important that you have a very good, strong base in level 1 so that level 2 also becomes easier. Because over here the subjects are new, the topics are new, so you are going to be building a base in level 1. Level 1 also has got a decent level of curriculum. Level 2 is going to take it quite a few notches above. Not quite a few notches above, but it's going to take, of course, to a higher level. But then you will be comfortable because the subjects will be old. So that part becomes easier in level 2. In level 3, we are not going to be having these subjects. We'll not be having these subjects, and the major focus will be on portfolio. In level 2, 25% weightage is equity. Level 1, we are introducing all the topics. In level 2, the focus is on equity. In level 3, the focus is on portfolio. 40 to 50% content is portfolio. So even when you're looking at fixed income, it is fixed income portfolio management. When you're looking at equity, it is equity portfolio management. When you're looking at alternate investment portfolio management. Because you're going to be clubbing everything, all that you've learned in levels 1 and 2 in order to apply it practically. So that is where level 3 comes in. Tell me, have you understood the syllabus? What is the curriculum? The subjects are these, and this is what will continue in your levels 1, 2 and 3. This is your entire curriculum for CFA.